2013 will be remembered as a strong year for global equities. Michael Strobaek, our Global Chief Investment Officer, is here to reflect on the developments and tell us what's in store for 2014. Michael, the year is drawing to a close. In your view, what was the most notable development of this year?
The most notable development of the year was that 2013 was about taking risk. In contrast to 2012 and the previous years, you could actually make money by being very cautious, in particular in government bonds. This year, equities have done very well, and government bonds have been doing, on average, rather poorly. The reason for that has been tapering. The discussion May and June about when will the American Central Bank start pulling back its quantitative easing program that unsettled bond investors, and it actually, if anything, made it clear to investors that now is the time to shift out of bonds and into equities. It hasn't really to any meaningful extent started yet, but we're seeing early signs that it could. And lastly, the 2013 will be probably seen as the year when the long supercycle in commodities was over. Commodities have been doing very poorly, in particular gold, and this is also a sign that money is flowing elsewhere.
You've been slightly more cautious on equities since August. How painful has this tactical positioning been against the backdrop of rising equity market?
Well, it has not actually been as painful as it seems by saying we have been underweight. The reason for that is that we have within our portfolios, we have quite a meaningful cyclical bias. We have an overweight to European equities, we have an overweight to emerging markets, and they have actually been doing quite well while we have been underweight. At the same time, we have risks in high yields and corporate bonds, and that overall means that we're actually having quite a risky portfolio, if you will. So the focus of having just this underweight is too narrow. It's about the whole portfolio.
But don't you think that rising prices also increase the pressure to close the underweight as soon as possible?
Well, the rising prices for us means that the question, how long will this go on? And we actually have a view that equities will have a good year in 2014. What we're concerned about, and what we've concerned about for some months now, is that equities have, if you will, taken the return from the future and put it all into 2013. And therefore we're saying you should be a little careful still if you want to stock up on equities. It is quite likely that we could see a correction. The more we go up within a short period of time, the more meaningful this correction can be. But it is also likely that we won't see a meaningful correction and that equity prices start their climb again. And that will be a moment in time for us where we say we will not miss that climb. We will close our underweight and go back to neutral. And if we see a large correction even, we will be overweight.
Returning to the regional allocation, you mentioned opportunities in Europe and the emerging markets. What's the basis for these?
Well, the basis and the backdrop is an improving global and regional economic environment, in particular driven by the US, but now increasingly in Europe, and also increasingly in select emerging markets. And we believe that this will support earnings growth. Valuation is not so stretched in Europe as it could have been, given that we're now up by a significant double-digit percentage point. And Europe is more attractive than, for example, the US, and so is emerging markets. So in totality, we see a clearer need going into 2014 for equity investors in particular to focus more on their regional allocation, and there we're saying focus on Europe, focus on emerging market, perhaps focus less on the US.
Thanks a lot. For more information on market movements and global trends, check out News and Expertise on the Credit Suisse website.